Beyond Meat stock, ticker symbol BYND, is a company that I was previously a shareholder of. And if you see on this chart right here, I have the year chart pulled up for Beyond Meat stock, BYND. In June of this year, I sold in the 140s. I believe it was around 145 when I still had my money invested in M1 Finance. Since then we moved to Fidelity, so I ended up selling my shares in Beyond Meat, and it seems like that was the perfect time because since June, where my mouse is at right here, this company has went down and down and down, and it is down 30-40% from where I previously sold my stock at. And the reason this company is downtrended so hard, and just on Friday, just last week, you're watching this probably a little bit days later, but just last week, it had a negative 11.8% red day. And so I wanted to go over in this video why this company went down so far, what I think the future looks like moving forward, and I'm gonna be covering the pre-announced earnings for this company, and this is gonna be the first of multiple episodes where I cover multiple earnings for all the companies that I own in my Fidelity portfolio that you can see right here. All 5 companies that I own will be going over: Chewy, Corsair Gaming, iRobot, Tattooed Chef, and CleanSpark. But thank you guys for tuning in. Check out links down below in the description for subscriptions to Yada savings accounts, credit card referrals, M1 Finance referrals, up to $50 for signing up with that one. Check out all that stuff down below. If you like the video, subscribe, hit the like button, and let's go ahead and jump straight into it. Now, Beyond Meat pre-announced their earnings. Normally when a company pre-announces its earnings, it's usually not a good thing. If they're in line with what people are expecting, or if they're looking to even beat it, they'll usually announce it on their normal earnings date. But if they're pre-announcing earnings, they're giving shareholders a warning, hey, get ready, this is about to get ugly. And that's exactly what Beyond Meat did. Now we could read over the shareholder letter, and it's honestly really boring looking, but just to give a couple of the bullet points, which are the ones that I wanted to talk about, they're expecting net sales, net revenue of $106 million for the quarter versus its prior forecast of 120 to 140. Now first off, let's go ahead and take that. 106 versus the average between 120 and 140. The average of that's 130. So you're already looking at, if we take our calculator, yeah, you're looking at 18% down from what this company was previously expected. Almost a 20% down mark in revenue from what the company's previous forecasts were, and that is not a small number. 18% down for a growth company like Beyond Meat is quite heavy. Now, I wanted to talk about what this company said for why it was hurting its revenue. It talked about some issues with its factories. It's talking about labor shortages, which pretty much all companies are experiencing right now. It also talked about issues with its food service businesses, with all of the restaurants that it services, that it's not getting the revenue fully back. And I wanted to showcase that here. Let's go ahead and jump over to hypercharts here. And I wanted to show the retail revenue versus restaurant and food service revenue. First, this is quarter over quarter. This is both stacked together. You can see that this line is a general trend up. It's moving in the right direction. But if we take off restaurant, we look at retail, things look pretty good. You can see that it's steadily going up and up and up, and things are looking good, and we're reaching levels that are upwards of $100 million in revenue every single quarter. Now, if we take off retail and we just put on restaurant and food service, it's about what you'd expect. It's going higher and higher, and then the pandemic happened, and then quarter 2 of 2020, it went into free fall, and it's steadily recovering since then. Now, to be fair, to Beyond Meat, I understand that not everything is back open yet. And I live in Oklahoma, which is a place that is very lax in terms of restrictions and shutting down places and wearing masks. We're really lax here compared to some extreme places like New York, California, and things like that. But that said, I really feel like the bulk of restaurants, as in like 90%, maybe I'm wrong because I'm from a more rural area, so maybe it's different, but what I see, like every place is back open. I feel like this is not a very good excuse to use restaurant and food service category as their excuse for not being back open yet. We're almost to 2022. The pandemic hit its peak in March of 2020. We're talking about almost 2 full years of recovery. And so I'm not gonna say that that's no excuse, but I don't know, it's kind of a cheap excuse to me. But with that said, that is not the issue here. Forget the revenue growth, and I think as a shareholder, the revenue, they missed 1 quarter. The overall trend of this company is going in the right direction. You see the long-term trend scrolling back up here. Look at the revenue with both retail and restaurant and food service. It is going up higher and higher over time, year after year. Look at the yearly revenue. You can see that it's pretty dramatically up year over year. But that's not the issue here. The issue that I have is the profitability. And one of the main things that I thought about when I was selling this company was when is this company going to make profits? It seems to me like we had a little bit of profitability a year or two ago, and it seemed like it was starting to go in the right directions in terms of bottom line earnings, in terms of the earnings per share. But this company, in terms of its profitability, that is by far and away my biggest issue with this. At what point does this company turn a profit? At what point do profits become a priority and it's no longer focusing just on top line revenue growth? Top line revenue growth is great. They're scaling their business. I get it. They shouldn't have massive profits. They're still growing at a rapid pace. But losses like these are unexcusable. Go ahead and take a look at this. This is the net income quarter over quarter. Now, going to 2017 to 2020, I understand, okay? This is understandable. A little bit of negative net income for a company that's growing 20, 30, 40% revenues year over year, sometimes even in its earlier years, 60, 70, 80, 100% revenue growth. It's completely understandable. Now we start to get to late 2019, early 2020, and we start to finally see a little bit of profitability. This is what I want to see. As that revenue is scaling up higher and higher, we want to see that net income slowly over time start to turn towards the positive, because if it's going to stay in the negative, then what's our point for owning the company? Well, looking at the net income, I realized in 2020 that the first quarter, quarter three, I understand, pandemic, can't help it, fine. But looking all the way, we're going into the middle of 2021. Even in quarter two of 2021, the losses are over double what was typical of 2019, 2017, these type of numbers. Let's look at like the average of these of 2017, 2018. The loss on average was probably about 7 million. A lot of these are 7. This loss is negative 19 million. Almost 2.5 times that of what the average was in 2017. Once again, pandemic, I get it. In my opinion, that's a little bit worrisome. I'll put it that way. If you're a shareholder, I think that these numbers should concern you. Now, another thing I want to point out here is I want to look at the balance sheet real quick, and I want to give the update for where this company is at financially speaking in terms of its cash and long-term debt. Now, this company's cash was starting to dwindle over the last couple quarters, and it was 214 million, 159 million, and then it had a big bulk up, and now it has about $1 billion in cash as of the last earnings, and we'll get an update on that in about 2 weeks from now, see what that update is. I expect it to go down because this company is likely going to put up a big negative net income number. I'm going to be really interested to see where that comes in. But looking at the long-term debt, it's starting to get to an issue where now the long-term debt is also going to start having bottom line negative effects. Because obviously when you have long-term debt, you have to make interest payments. You're losing interest, whether that's to a bank, to shareholders, whatever it is, that is a negative for your net earnings, your bottom line earnings per share. And so now they have 1 billion in cash and cash equivalents, and in 2 weeks that number will be updated. And it's actually going to be less than that. Expect it to be under $1 billion now, and their long-term debt is now 1.1 billion. Now that doesn't mean that it's a horrible balance sheet. It's not a risk of going bankruptcy or anything. But the thing is, this company used to have hundreds of millions, if not billions of dollars on the balance sheet with no debt. And that was one of the main reasons why I love this company. And now the balance sheet is getting uglier and uglier because this company cannot turn a profit. And every day that they can't turn a profit, they're either gonna have to seek out more debt or dilute shareholders, which is not good for you as an owner of the stock. Now looking at the analysis tab, scrolling up here in Yahoo Finance and looking at the analysis tab. First off, for the year 2021, we talked about that. It already showed the first half. The year's going to be ugly. They're going to lose 1.12 in earnings per share. And if you take the shares outstanding, 63. So basically the estimates where they're at right now, what is that? That's about $70 million worth of losses. Okay, I get it, whatever. They're still recovering. But looking in the future, looking at next year, this company is still producing negative 0.44 in earnings per share, which is, what is that? Just doing that in my head, that's about 30-something million dollar losses, about $30 million worth of losses. And the thing is, if you look at the earnings per share trend, this is what analysts are expecting, this little column right here. 90 days ago, they projected only 94 cents. And now, as of today, it's negative $1.12. What about next year? Well, next year they're producing only a small loss according to analysts, and now that number has since doubled since just literally the last couple of months, and they're now projecting negative 0.44 in earnings per share. The earnings per share for both of these, both this and next year, is going in the wrong way. Now, the one thing that is still going good for this company is the revenue growth. $545 million this year, 34% revenue growth. That number will come in lower due to the recent announcement that they just came in with, but still, even with this not coming in at its maximum capacity, expect this company to at least produce something like probably 25% revenue growth year over year, and the same thing for next year. $826 million next year, 51% revenue growth. Maybe not expect this high, maybe 800, maybe high sevens, but still fantastic revenue growth. I would expect at least 30, 40, maybe even higher than that in terms of its top line revenue growth. And this is the time when I think you have to ask yourself, how much do you believe in this man? Ethan Brown. Ethan Brown is the founder and CEO of Beyond Meat. I think he's very credible. I like the guy. He's a leader. I think that he has some great credibility to his name, but that said, at what point do you begin to question his judgment and the other leaders behind this company? I think you're putting a lot of faith seeing these losses and this type of debt that's being added on and really trusting the company. Now, I think long term, I'm bullish on the stock, and I think that long term we'll see a lot higher than $90 a share. But this company is not trading cheap whatsoever. And as of today, I have to say, I definitely dodged a bullet. Luckily, it was one of my smallest investments, so it wasn't really a major issue either way. But there's a reason why I haven't been investing higher and higher into Beyond Meat. That's because they already have a very generous valuation, and the fact that they keep on losing tens, if not hundreds of millions of dollars is concerning to me. And so right now, Beyond Meat is not one that I'll be messing with. I think if you're buying the stock at a discount, I don't think you're crazy. I think this company's massive revenue growth and eventual, whenever that is, eventual profitability will be great. So I'm not against buying it, but for now, I'll be holding off. But anyway, guys, if you have any opinions, if you think I'm right, if you think I'm wrong for my opinions on this stock, if you think that the losses are very short term, if you think this company is going to be losing money for the end of time, go ahead and let me know. But in the meantime, guys, I would invite you to subscribe, check out the stuff down below in the description, and stay tuned for my future earnings reports on the companies that we'll be covering. The next video, I believe we should be covering iRobot. I think they cover in the 27th, and they're my third largest position. But thank you guys so much for watching, and I'll catch you guys next time.